Welcome to The Weekly Trend, a podcast for navigating the markets through the lens of technical analysis. The Weekly Trend podcast is provided for educational purposes only and does not constitute any professional advice. Listeners should not act upon the information or content without first seeking advice from a registered financial planner.
Welcome back to the Weekly Trend Podcast. Today is Friday, July 24th, 2026. S&P 500 currently sitting at 74.58. I'm David Zarling. I'm here with Ian McMillan. Almost another week in the books. Everybody is kung fu fighting Chop Fest out there.
I hate it.
Yeah.
If you couldn't tell by the last 30 podcasts.
Yeah. Consolidations.
Still chopping. I thought we might be done with the chop. We were just going to get the breakdown, which at this point, I mean, it's a direction, right? At least it's a direction. But no bueno. Everything's kind of bouncing where it needs to.
Yeah, and I still go back, I think it's appropriate if you have semiconductors moving 85% to the upside since March of 2026 that we consolidate. It's important to keep that context. We like making money for clients. And so when consolidations happen, they're perfectly normal. That doesn't mean that we're not allowed to be grouchy about consolidations. And here we have a consolidation if we're using the S&P 500 in what is this, 4% range? Yeah, 4% range since May, June, July, almost the end of July. Can you believe it? Almost the end of July.
Over halfway done with the year.
And so, it's a quality consolidation, really. If we move higher, as a technician, the study of technical analysis, the study of supply and demand, consolidations should break in the direction of the primary trend. If they do not, then we have something else in our hands. When I say should, I don't mean like they have to, it's a law or anything like that. I just mean as a trend follower, consolidations, the confirmation of the uptrend is consolidations break towards the direction of the uptrend. What is that level, do you think? Not what you think. Basically, when you look at the data, price-wise, using the S&P 500 Ian, confirming an uptrend, where do we have to get to?
I guess all-time highs.
Still some work to do. But, I think that's the difference between when you're in a consolidation. The question is this digesting the prior move and we move higher, or is this distribution? So if we're going to operate under those two assumptions, I think the red flag or orange flag, no, I'm going to call it red flag for me is MAGs, the Magnificent Seven. Yeah.
The MAGs. They carry a lot of weight. They are definitely either a tailwind or a headwind at this point. They've carried a lot of breathless markets.
Yes.
And definitely a headwind. Mega caps across. You see it. I think tech gets the most chatter when you talk about, but you see it in consumer discretionary.
Ooh.
Pretty weak sector.
You're talking about consumer discretionary? Brutal.
Yeah, it's pretty weak sector if you look at it from a cap-weighted perspective, but not that bad under the surface. Same for tech, small cap tech, broader tech versus cap-weighted tech. You could maybe say the same for communication services. They've definitely gotten hit. Google kind of helping there, though.
To the downside.
Netflix not too hot.
You're saying Google not helping in the fact. You're saying Google's helping to the downside, not helpful from Apple.
Yeah, well, yes. So Google had been kind of the last thing helping it hold up. It wasn't even holding up, but it was Google had been the last one. Now you lost Google.
Well, the Magnificent Seven below a 200-day moving average, which is flattening out. So I think the best way to communicate that is a flat 200-day moving average means hot mess territory. So if you have your largest 7 stocks in a hot mess, really that's going to impact your cap weighted sectors and indices across the board. So tech, mega caps, S&P 500, probably a hot mess until this resolve.
I agree. Other things act fine, I guess. I mean, there's definitely stocks making all-time highs.
Yeah, what are we talking about? What do you got? Transports.
I mean, not like broad transports.
Well,
but
what about broad transports minus Uber?
oh, I guess IYT looks pretty good. Pretty good relative chart. Oh my gosh, am I buying trans? I mean, could be. Maybe second half of the year is very non-techy.
I mean, Uber is 13% of transports, and if you take it out at IYT, transports look pretty good on a relative basis. How bearish on the market are we getting? I think 2 things can be true at once. CHOP is not fun for a trend follower. The information we have on hand about, for example, transportation stocks minus Uber doing very, very well. Financials doing just fine on an absolute basis.
Yeah, financials look, I mean, they're hanging in
there.
Are
we going to get super bearish on this market?
Bank of America, $62 today.
Are we going to get super bearish on this market if transportation stocks are doing fine on an absolute basis, industrials are doing fine on an absolute basis, financials are doing fine on an absolute basis? I guess the caveat to that would be how bad would a magnificent 7 correction impact things? That could be a thing. There could be, is this?
Yeah, probably. Eventually would spill
is this a scenario where equal weight S&P, which many investors don't realize that there's multiple ways to cut a cake. There's cap weighted S&P and then there's equal weight S&P. Is this one of those scenarios where equal weight S&P outperforms cap weighted just because of what we're seeing out of mega caps and Meg 7? Could be.
Used to have a reverse weighted S&P.
Yeah, YPS.
But that's not it's a tough product. That was just the wrong
environment. And then I'm sure the individuals behind that really smart, really love it, love the idea. But isn't it anti-momentum? If you say reverse weight S&P 500, aren't you saying bet against momentum?
Yeah, I don't think it's probably not a buy and hold strategy.
Okay.
But I mean, in an environment like this, could you?
Yeah, there might be some alpha there.
Make a use case for
absolutely.
it. Yeah,
for sure. And I think it's fascinating as technicians, you study if you use ETF RSP versus SPY. Might be an argument here for a return to equal weight S&P, which matches what we're.
Yeah. Though, this every time people get like this, then Micron's up 25% and we're all back into. Every time people start wondering if the Russell's going to do it, could the Dow do it, could the value stocks, could the JP Morgans of the world do it, and they let us down.
Well, and part of this could be.
I wouldn't say they let us down. It's more like the tech just.
I think you're highlighting an important aspect. If we just look at let's take JP Morgan versus semiconductors, relative strength ratio analysis. I mean this move, aren't we just saying this is a reversion to the mean? We talked about this before hopping on here. Reversion. We're not seeing this is a new trend. We're not saying, for the next 10 years, JP Morgan's going to outpace semiconductors. It could. I mean, that's a lower likely probability. We're just saying, we're reverting towards the 200-day history of that.
Okay, but if you go backwards, if you work it backwards, so JP Morgan outperforming a Microsoft, that would be a first crack for me.
Okay.
If it started outperforming some of the mags, JP Morgan versus Microsoft looks pretty good. JP Morgan versus Apple. And that's an easy target. I'm kind of cherry picking. As I could say JPM versus Apple or.
I like this. So you're saying.
And it doesn't look any better. I mean, JPM versus Amazon, I think. I mean, right? Yesterday helps. versus Google. I mean, yeah, intermediate term, I could definitely make an argument there. So if these dominoes start falling, then it makes you wonder, like, okay, well, will it just start outperforming the NASDAQ? And then if it starts outperforming, I don't know. I think that there's some growing, evidence, thank you, that we could actually be doing it. Like, we could actually be getting out of the tech mega cap era. I wouldn't say completely unscathed. Yeah, we'll see. Or was 2022 that? I mean, was that 2022? Because if you go back and look at Apple since the 2022 bear market, I mean, not a very. I mean, it's outperformed a little bit.
So, Ian, I think what you're bringing up here is fascinating. When you pull up a chart of JP Morgan versus Magnificent Seven, so JPM versus Mags, I think you got a case here.
I think you could do it.
And that doesn't mean the end of a bull market. That just means, are we over the megas? And I guess there's two ways that, I shouldn't say there's only two ways, but the two ways that stick out to me that this could play out is when you think about the 08, 09 correction, heading into the 08, 09 top, or I should say 07, 08 top, it was financials, industrials, energy leading. It was value over growth. But during the correction, it was growth and tech that held up the best. So do we see another?
Yeah, maybe people are positioning themselves before a correction.
Like I'm not ready for that yet, just because we have advanced decline lines, new highs. We got bullish percent indexes now, and
why don't you?
I would add that, like, small caps leading throughout the year means they likely lead throughout the rest of the year. I'm not ready to call mega cap growth or tech dead. I just think there's alpha in other places. But I would say the Magnificent Seven struggling on a relative basis versus S&P 500 is a shot across the bow. What were you going to say?
It's interesting. It's definitely, it's not a new thing. This has been going on. I mean, I guess I'd rather have multiple years of distribution that kind of gets swallowed up versus a dot-com bubble 2.0. I was going to ask, why do you think so many staples stink? I mean, not just on a relative basis, but like the Walmarts, Costco's. I think that's a debt thing, like an interest rates thing. Not to get all macro-y and fundamental. Although utilities look okay, and they always get the argument that I don't know enough about the corporate debt world. Utilities are holding up fine. Could probably also segue this into the fact that 30-year Treasury yields back up above 5. I mean, they've been above 5 for a couple weeks now, but we are back up at year-to-date highs we saw back in May.
Yeah. So you got me
5.14.
You got me a couple pieces here. You talked about utilities, staples. Like, why do they look so bad? Rates. So from a technician standpoint, in a market analysis, you like to see things outpace staples. So staples okay on an absolute basis, underperforming on a relative. We like to see that. And you're just saying, well, they're also really struggling on a absolute basis.
And then you look like Walmart's and Costco.
Yeah. Is it because there's some elasticity in absorbing inflationary pressures? So, like, I mean, in the last 6 years, I think groceries are up 40%. Like, if your grocery bill is up 40% over the last 6 years, Costco is probably absorbing some of that and trying to adjust pricing.
Yeah, McDonald's is considered staple, right? That's an XLP. Yeah. No, it's an XLY.
Yeah, it's discretionary. I mean, I don't.
Is it?
Ian, I don't have to go to McDonald's.
Well, I was just saying they got a really bad chart too. I know that they're starting to lower prices. Probably gonna get like Beyond Meat or something, some mystery meat. But I like McDonald's, so
I
know that's not healthy.
hey,
but
you're allowed to like what you like. It's America. But I think to your point, XLY on an absolute basis, there's some weakness there. If I'm allowed to do the fundamental soapbox, it's just there's some absorption or elasticity to how do we handle the price pressure, inflationary price pressure on goods that we're selling. There's probably some impact there. I don't sit there and say that there's not. And then I feel like you had two tag-on questions, and I'm missing one of them. You talked about staples, and then we got to rates, but there was something in between I felt that was important. But I think rates is an important one to touch on. What are you seeing out of there?
it's tough. If you were the part of the rates lower crowd, rates are going lower, which we were not. It's probably been our, I don't know. I wouldn't say our. Yeah, I don't know. We've been pretty loud and consistent about that over the last...
Oh, that we're in a new 35, 40-year rising rate cycle?
40. I bet we've been saying that for 3 or 4 years on this podcast. And
yeah, go ahead and check
letter.
us on that. You're listening to this, go back.
Yeah.
You can look.
You can go back years on that. That like, all right, well, yeah, we're getting a new cycle here.
This next branch or leg probably is higher. And it is interesting. The Fed funds rate futures indicate 82% likelihood of higher rates. Not shocking based on the charts that we're looking at. Whether you're looking at 10-year rates or 20-plus year rates. I mean, we could be sitting 6% rates in a couple months. Would that be surprising? Not at all. Which has lots of real world and portfolio ramifications, right? We've been talking for at least 3 years about 60-40 portfolios are dead. Like, how are you handling your bond allocation? Really need to look into that. And then obviously your debt maintenance process. You're talking about mortgages. Really interesting to think about real estate. So we get a breakout in 10-year rates, 20-plus year rates, and then you look at what real estate is doing as a sector.
Yeah, real estate looks pretty good.
Isn't that interesting? You get...
And there's a lot of REITs, specialty, like there's some good stuff in real estate, good individual charts.
In this interest rate environment, I think 3 years ago, many people would be like, you got to be joking that real estate would look like this with rates looking like this. Who are we? I think the market knows more than we do. Maybe
home builders look fine. I mean,
maybe there's...
I don't know. I wouldn't say like they're my top thing to go buy today, but
yeah, they're not alpha generators, but it's okay. But maybe there's something to be said for real versus fake. Like, real estate's about as real as you can get.
Real versus fake. Well, maybe that should be our title.
We could do that.
Real versus fake. Is this society just done with technology and fakeness?
Could be.
Now we want to go buy tangible things.
Could be. I mean, a house is pretty tangible.
Like
a house is about as tangible as you get.
A house, bars of gold and silver.
Yeah, what are you seeing out of that? I mean, that was the darling Maynard.
Shipping looks pretty good. If you look at BOAT, BOAT,
shipping. Oh,
does that fit our
physical
tangible? That's actually real. I'm glad I came. We'll have to notch that down for the market call.
And I think.
And okay, I got a question for you. And so dollar's staying above 100. Markets haven't totally crapped the bed.
Yeah, you're just saying dollars above 100. We got S&P sitting in a 4% range. You got S&P outperforming VEU, which is international stocks minus U.S. stocks, since the beginning of March, and DXY has been rising since the beginning of March. What's the deal? Can I put words in your mouth? Is that a fair? It is interesting.
I think also, I guess, right? I mean, we're in a strong dollar environment. I guess we see who the outperformers are. Last time we kind of had this would have been October 2024. I can't really. I mean, Q4 2024, a little rocky. No,
Yeah,
that was fine.
it was great. You're talking about like for U.S. equities? Yeah,
Yeah,
U.S. equities.
a little
U.S.
drawdown
equities
in.
Q4 plus 10% with the dollar rising. It's possible.
Okay.
And I think that's one of those things in textbooks, right? You go to these post high school institutions, and they tell you, oh,
Post high school
yeah, I
institutions.
think that's
That's
where we're going
good.
with, because I'm not convinced that they're all that they're cracked up to be. But you get a rising dollar, oh, that should be a headwind, and it can be at times a headwind for equities. But man, if you actually look at the data, there's times where the U.S. dollar on a trade weighted basis is rising, equities are rising. So I don't think the dollar above 100 on a trade weighted basis using DXY is like a death knell for equities.
I think the market's just telling you. I mean, it's good for some, bad
Yeah.
for others. That's like anything else. Small caps are still hanging in there. Green today.
On
I mean,
the micro caps versus mega caps trend is still alive since the beginning of last year. So pretty healthy style box or mega versus small rotation, pretty good.
you say megas over
No,
micros?
micros over megas,
Micros over megas.
right? Outperformance
I mean, that's actually pretty.
since
I mean, longer term. Hey, back below the COVID highs. Had a big run up into COVID, right? Yeah, because everyone went into mega caps during COVID. I don't even know if we called them mega caps then.
bit of
When did that start?
like Magnificent Seven megas thing.
Yeah, it was like
Oh,
2022
I
ish.
feel like that was.
Whenever the first one got to $1 billion or $1 trillion market cap, Apple maybe, because there was a thing, wasn't it? Apple and Microsoft in a race, be the first to $1 trillion.
Feel like you're onto something there.
But yeah, rates higher, hasn't cracked the market yet. I think that's
Well, and don't you think though that
big story.
rates higher doesn't have to break the market. It just is rate of change. So the rate of change of, because this is all about cash management for these companies. You're talking about what is the cost of debt. So a consolidated rate environment that we've seen now for quite a few months to years. I mean, in some sense, corporate America has handled it better than public America, the government. And so maybe they're ready for the next leg in rates. Now,
That's why you don't do. This is why you don't do the
That's
arms.
right.
That's why you don't do adjustable
Nope.
rates, people. You don't want to play that game.
So to answer your question, Apple was the first Mag 7 company to reach 1 trillion, 2018. Amazon was second.
Oh,
Amazon-
second.
Apple
Amazon.
going out to new all-time highs today.
It's the lone one holding on. Tesla looks terrible. That's also not great for
Yeah,
Consumer
Tesla down
discretionary.
18% on the week.
SpaceX. I mean, I don't think they had any. They don't have any inverse funds yet, do they? Of course. Oh, yeah, they do. But when did this one come out? Did come out just in time. Good for them. Yeah, the SpaceX was a pretty clean.
Yeah, SpaceX trading at 112, all below its IPO level. But I mean, how many times, like, when I say that, and there's probably listeners on here that are young enough who are like, oh, that's so crazy. No, it's not crazy. This is what we see out of IPOs from time to time.
Meta did the exact same thing. Facebook, well, it's Facebook, but back then.
But
Did the
what do you
exact
think
same
about
thing.
so there's something in IPOs where a certain amount of shares become tradable. So you trade SPCX, SpaceX, and they've got a staggered lockup schedule. So right now, 5% of SpaceX shares are trading. 5%, that's it. Now, when you think of like fund makeups or index makeups, how much selling had to happen in order to buy SpaceX? Because I mean, SpaceX is now like in the top 10 cap wise. I mean, it's pretty close. Top 15, top 15.
Yeah.
And then you threw.
I have a.
Well,
go ahead.
I was just going to say, don't lose your thought, please. The next major
No, I won't.
date, we get the next tranche of eligibility traded shares of SpaceX.
And that's like a 90-day lockup from, because some people have, like, obviously there's a standard 180
Yes.
days. I think Elon's is like even longer.
Yep. As the founder and owner, yep, that's longer. But August 6th, 20% of the eligible group comes available. That's 7%. So right now we're at 5% of SpaceX is able to be traded. August 6th, 7% added on to that, so 12% of shares.
What I wonder is, I have a theory.
I like it. Let's hear it.
Because the era we're in, right? And these people, they're probably educated, more sophisticated. I think that they could be, I think a lot of them could be synthetically, whatever they want to use. You can hire a firm to do it for you, but they could be shorting SpaceX themselves. And I wonder if right, they were doing it. This is what a normal, I feel like pretty normal person to do. If you knew if you were going to make $50 million at X date, the potential to make $50 million.
Once you just lock it in.
Yeah, wouldn't you hedge that out and be like, all right, like if we get below the IPO price of $150, we need to be like 1-for-1.
Well,
shorting.
I don't even know 1-for-1 shorting, but all I'm going to tell you is that if I'm a SpaceX holder of shares of significance, so I'm an employee, I'm a higher up, whatever, I'll also add the caveat: if I got a wife, if I got kids, and you're sitting on,
this is your ticket, right? This is your ticket. You made it.
This is how I provide for my family. I'm sorry, we're selling. Yeah.
Yeah, we're selling. And I'm not going to sit here and lose $20 million during my lockup period. Like there's nothing I could, like this is not 1952. Right. We all have tools, all these people. And I know they were hiring wealth management firms. Which is smart. Like they would, groups of employees would get together and like vet wealth management firms, which fine. If I was, you're literally going to have like lower tier employees that will be worth $20 million overnight. And that's great. That's that's awesome to me. But like I said, these are sophisticated people, and there's just the ability to do it. So I wonder how. So this gets back to my point: is I wonder how much of this it's been a pretty. Have we had any green days since it broke 150? Maybe one.
You're talking about SpaceX?
On SpaceX, one green day yesterday.
June 16th is the highest SpaceX has ever been. Your point is, since June 16th, what does life look like for the overall market? Pretty choppy. And then, so July 10th, SpaceX closes at 145. Okay, it's had 2 green days. I take that back. 2 green days in the last 2 weeks, give or take. 14 days. And I just wonder, right? Because I wonder how much of this is like I wouldn't call it like a death cycle, but like are these employees going to do this to themselves? Well, do this to the stock, but it doesn't matter because they're net neutral anyways. Yeah, what I think is important to keep in mind is these lockup schedules. So if we look at it from a 30,000-foot view, we have the biggest IPO we've ever seen, largest ever in nominal terms.
Yeah.
How does the market absorb that? And so far we've moved arguably sideways since that. Not too bad, not too shabby. Now, for the employee of SpaceX who is now exercising those options, which is great. You should, if this is generational for you, do it. It'll be interesting in the weeks and months to come, absorbing the supply available in the next few months from people exercising their shares. What does this look like? And I think it's important to keep that in mind. I'm not saying that's a negative for the market. I'm not saying that's a negative for SpaceX, but this is a generational wealth producing IPO for employees, potentially for stock market participants. But I think we have to go in eyes wide open on what does that mean, supply and demand. When we say 5% of shares are available, now we're at 20% shares available. And then you have all these nuances. You've got indexes, you've got funds that have certain mandates about what they're going to hold. And all of a sudden, now we got to sell out of MAGs to allocate to SpaceX. That's a factor. And
SpaceX is SpaceX, and it's in the NASDAQ already. Is that the only one?
I think SPOO's held off.
I mean, I guess it'll be in the Russell indices because that's just straight up market cap.
Yeah, S&P backed off. It was gonna do it. Backed off. NASDAQ 100 in it. I mean, NASDAQ 100, it's top 10 right off the bat. But S&P 500 held off. Was going to do it, backed off. But I mean, it's generational. This is a huge thing. And then in the backdrop, you've got this AI piece, the OpenAI, the Anthropic. What does that all look like? Because all of these are, the way I would describe them is like disturbances in the surface of the water, like where liquidity is going to go, right? Because if I'm running a tech fund and I've got a mandate that I've got to be allocated to tech or I've got to be allocated to aerospace, invariably I have to sell some things in order to allocate towards SpaceX. That's just the mandate. That has impact on things. And so while this unveiling is happening, SpaceX, OpenAI, Anthropic, I'm probably missing something in there. There's going to be some variability on what's going on with makeup of funds and indices. And that's the hard part. Is this marking a top? Is this just marking volatility in the near term being a 6 to 12 month period? I don't know. But we're, from a broad perspective, we're still sitting in a 4% range on the S&P. On the flip side,
I know the NASDAQ is by far the weakest. Golly, this thing, man. It's a bum.
So it's a unique time. I mean, for investors, I don't think we get to sit here and say, okay, we don't get to ignore what's going on with rates, right? We're right on the cusp of 20 plus year rates, potentially breaking to the upside. We have, you brought up earlier, discretionary stocks, a lot driven by Tesla and, obviously tied to SpaceX in some sense with Elon, gapping down. You've got triple C credit spreads, which haven't cooled off since fall of last year. Junk bonds haven't really moved higher. Dollars above 100. So it's a really unique time. And the beauty of unique in markets is there's really no such thing as unique. That's what the market does, is consistently be unique. That's the hard part. Which brings me to an interesting thing I want to talk to you about, Ian. You are a thought leader in the CMT, charter market technician, technical analysis community. And
am I?
I think so. Yeah. I think you are. And you come in contact with a lot of young individuals looking to get into the space or grow into the space. And I find it very interesting, one of the comments you made out on socials about, so I'm going to ask you to comment on this without too much adjectives on what you're seeing out of young up-and-comers in our technical analysis community, right? Because there's a big delineation between being sell side, so selling research, and buy side, which means actually making decisions and investing money on behalf of yourself and others. What are you seeing in that? Can I put you on the spot for that?
Yeah, I didn't know if you were gonna read a tweet off or not. I mean, right, and I think it's different. Sometimes you're on Twitter and you are ranting about whatever. But yeah, I guess I know. I think I know what you're referring to.
Yeah, I will read it. I will read it. I've talked
Okay.
to,
Because I think that would probably
yeah,
give other
so
people context.
this is back 9 days ago. I've talked to a few young and aspiring technicians lately. None of them have interest in the buy side. Not a single one. They just want to do
Yeah.
research and create content. That's it. Just make graphics to post on social media. I literally had a kid tell me he'd rather make less money if it meant he just got to do content. Zero desire to actually put their necks out there.
Yeah, I mean, it's I guess I don't know if it's like a dying generation or whatever. Just, I think what I find wild is this is by far, so like let's use Eli's, your oldest son's generation, for example. These like young 20, and he's definitely in like the younger 20s, younger's 20s.
Yep, 21.
But still in the like, so out of undergrad, is aware of the stock market. Like his generation is by far the most, and I would put Pratty in this category too, our intern we had. Like, 16, 17, 18, like, I'm not saying that they're necessarily making consistent money in the stock market, but like definitely the generation with the most access, definitely the generation that, has talked about it the most, is trying to educate themselves. We've talked about it a lot on here about this being the golden age. We talk, with access to, I mean, you can go buy an ETF and I mean, you can buy anything now compared to just 5 years ago, 10 years ago. Oh my gosh, what is available at your fingertips with pretty good liquidity is awesome. So we've had this generation of all like these kids where, I mean, they've learned about it, and the outcome of it, I don't feel like it's been this rush to be like, yeah, like that's what I want to do for a living. Like I want to be the next David Tepper. I want to be the next Paul Tudor Jones, or not even that. Like, oh, I would want to own like it just has kind of culminated in, oh yeah, like I think it'd be cool if I got paid to post pictures on social media of stocks and stuff. And I don't know. I just find that disappointing that so many of them, it ends with them just wanting to do content. And I think a lot there's a lot of people that, I mean, you never know how much people are making, right? As far as like, if you want to make a living off of social media or you want to start research company, which really, right, at this technical analysis research is, here's a chart, here's my thoughts on it. So pretty Twitter-ish, and that's fine. I mean, that's what probably TA should be. You show me the charts and I guess, why, but yeah, you just never ever hear the young kids say like, oh, I want to be an analyst and go work for someone and provide reasonable ideas. That's how I was, right? I mean, you have the goal of being a portfolio manager, but yeah, I just was always like, I'm going to go to the buy side. I'm going to like do my time, learn, and then, whatever, someone eventually gives you a shot to be a portfolio manager, but you just never. And yeah, the money thing, and that's, I guess, that it doesn't matter. It doesn't matter. That's the correct thing to say publicly. If it was my child, we'd be having, I'll tell you that. If it was my child and he came to me at 22 and was like, well, money doesn't really matter. I just want to do what I think is cool. Sorry, bud. It's not 1982. I don't. Yeah, I'm disappointed by it because these kids are educated. They are aware. I'm not saying that, I mean, they have good technical analysis, but for it to end with, like, I think that this would be really cool if I could get paid to post this on Twitter instead of, I think it would be really cool if like a director of research just paid me a salary because I had really good ideas that made clients money.
Yeah, and I no,
that was really
I know.
long-winded.
Do
and I
not
apologize.
apologize because I think it's spot on. I think it's addressing a certain thought process or ethos in our current era, which is, are you in this for you or are you in this for others? Because
Yeah, maybe that's it.
You can post charts and I'm not saying posting charts or content is inherently self-focused at all, because part of that could just be, I mean, part of the reason why you and I got connected, Ian, is
Exactly. I mean, I have this
correct.
job because of Twitter.
So
that wasn't my
right.
goal, though.
You were just, this is my thoughts, and that's how we got connected. Now you're using those tools to impact, and think about this. I mean, 600, 700 families who have portfolios with us, and now you're impacting their livelihood. To me, that has a lot more holistic meaning to your life, my life, their lives, than just being famous on Twitter.
And you don't have to like go pick stocks. Take a David Yoakum. David Yoakum went into credit. I just did a CMT sponsorship for a kid in St. Louis who works in risk management for Schwab TD and is using his CMT skills. Like, this isn't like, oh, let's go pick stonks and like try to be up 100% on every year. Like, there's other technical analysis out there. But yeah, it ending at with like, wow, I have this skill set and I'm just going to like, I think it'd be really cool to be on social media and see if it gets me followers. And like, that's just where it ends.
Where's the,
and maybe like I'll just get like a job at Kohl's, and then in my free time, I'll post charts. I'm not hating on Kohl's. I probably shouldn't even use, no offense to Wisconsinites, especially. No offense. Are they headquartered in Wisconsin or Minnesota? Okay, yeah, I thought so. I don't know. Maybe it's an ambition thing. Maybe to your point, there is no like, and this gets into like a whole, I mean, we could go for 8 hours on like, maybe it goes back to like they're doing it for themselves because there is no one out, like there is no spouse or future partner where they're like, yeah, I probably should be trying to make like an extra 20, 30 grand a year. That probably would be better for me and my spouse, and like, oh, if we want to have kids. So maybe there is like where this generation is just like, I don't really care about money. Like, it's just me, and it's probably just going to be me because I'm so black-pilled on the future.
And for some in the gig economy, the social economy, the clicks economy, is fame have more currency than actual currency?
I mean, I definitely think at the high school level it does. And you read, even when Pratty was interning for us, and we found Pratty. I mean, truth be told, it's probably going to go against my argument. I mean, Pratty was posting stuff on Twitter at like 17, 18. And I didn't know, but he used it as a platform to be able to say, hey, look what I've been doing. Would you give me an internship? And it was a paid internship.
Yep.
Correct. Yeah. So, I mean, he was even doing the kid did it in college. He was on every market call for 3 years in college, which is insane. Yeah. So, and well, when I was saying, even when you'd see these surveys where it's like, oh, we interview Gen Zers, and 33%, I would see this 33 to 34% number. You'd ask them what they wanted to do when they grow up, and they'd say they wanted to be a social media influencer. And that was so wild to me. But now being like down the line and having more interaction with them, I mean, other than like the 2 interns we had, your kids, I don't really know of or hear about too many Gen Zers, or hadn't at the time. Yeah, being 3-4 years further down, man, that those interviews might have been pretty spot on. Because I guess that's what they want. Is it social currency? I think it's really cool to them in high school, which sucks. I mean, there was no like social media followers when I was in high school or college or anything. I don't know. But yeah, I just disappointed. Like, to me, the buy side is like the ultimate. I don't know. It's like getting to play the sport. Like, would you rather shoot hoops, be out there with a team shooting hoops trying to score, or would you rather just be the guy that gets on the radio station and judges how the team played and talks about what the team should have done to win or whatever, you know?
Which I think is lame.
I don't know.
I'd rather be in the game than commenting on the game.
Yeah.
I mean, respect to those who comment on the game, but
I guess we need people who comment
do we?
on it. I guess.
Do we, though?
I mean, sells clicks. Yeah, I mean, I don't know. But yeah, just definitely, and I don't want to say that that's all that I've come across. Like, I mean, I've definitely come across my fair share of guys that have gone into the, I mean, like I said, Pratty's, you know, an analyst, and he's in the buy side, and I think of who's at Potomac, and a lot of younger guys. But I guess I say my message would be for younger people out there who want to do it. I just don't think that your end goal should be, I want to make charts on Twitter and see if I can be chart of the day on the chart report and see if I can get to 10,000 followers. And
I think that's like anybody listening. If you're listening because you want to be content king, let's get into the real stuff. Like, I get it. It's easy to post a chart. It's interesting to post a comment. But in the end, are you in the blood, sweat, and tears? Like, are you in the gritty? Like, are you actually having to deal with the emotions that come with investing your own money, investing other people's money in a market like the current one that we've seen since the end of April, which is just chop? Like, do you have that gumption? And I'm going to read a quote by one of my favorite guys, Teddy Roosevelt. It's not the critic who counts, not the man who points out how the strong man stumbles or whether the doer of deeds could have done better. The credit belongs to the man who is actually in the arena, whose face is marred by dust and sweat and blood, who strives valiantly, who errs, who comes up short again and again because there is no effort without error or shortcoming. But who does actually strive to do the deeds, who knows great enthusiasms, the great devotions, who spends himself in a worthy cause, who at the best knows in the end the triumph of high achievement, and who at worst, if he fails, at least fails while daring greatly, so that his place shall never be with those cold and timid souls who neither know victory nor defeat. And to me, Ian, if you just want to be content king, you're not really sitting there trying to figure out what victory or defeat is, in my opinion.
Well, yeah, and a lot of it that I hear, it's more of like, even the day, like, oh, but it gets, 700 clicks, and it's, I mean,
dude, I can moon the
I don't
camera
know.
and get 700 clicks. Is that talent? Is that value add?
I think they see other people doing it, right? And we're so big into the data, like so big into the slicing up of the, like, okay, it's a midterm year. The top weighted sector is down year to date. But like, the way, like, we add all these little data points to find like, the last 7 times this has happened. Here are the 3, 6, 12 month forward returns. And that stuff gets a lot of clicks. And it's cool and it looks nice and it's got like the little, research logo on it and people talk about it, lots of comments on it. But I mean, like, I just don't think at the end of the day, like, I'm not convinced that people are paying for that. Like, I wouldn't pay for that. I click like on Twitter, but I'm not paying for that.
Yeah, get my heart for free.
Yeah, but I'm not like, I don't care. I'm not putting $5 million in a trade because of the last time this happened, the 6-month earns on bank stocks were really good. Okay.
Good, great, grand. Yeah,
I understand that got a lot of, like, they got 300 clicks and Ryan Dietrich retweeted it and there was a lot of buzz about it. And again, I'm not like trying to call out Ryan I mean, that's actually more of a positive
100%.
to him, right? Because it's,
Totally agree.
yeah. And like, wow, look at that. And it's the rush, the dopamine hit from, I don't know, man. I guess those surveys were right. I guess that's what I got back to. Those surveys were right. These kids that, I don't know. But a long rant.
No, I actually really appreciate it because when I look at the generation below me, which is you and Kevin, supreme talent, just incredible talent.
And Kevin wants to manage and like make decisions.
Yes, 100%.
He does now.
And what we're
for all of our
talking about
fixed
is the
income.
generation below you guys. Like,
Yeah.
they're supreme talent. Don't settle for social media validation. Like, don't bow to the god of social.
I don't think Kevin's ever.
Well, he
posted
might
on
have.
Twitter.
I don't care because he's
Maybe
one of our
once.
best teammates we've ever had. The guy drives innovation
No,
forward.
yeah,
Does great things for our fixed income stuff. I mean, my point is, the guys who are listening to this and gals who are the up and comers, do not bow to the god of social approval. Like, that is not the end all be all, is social approval, the hearts, the likes, the shares, the whatever. Get in the trenches, make the decisions for people. Because Ian, one of the most fulfilling things that we do on our team is manage money for the secretary of the cheese company who saved up $1 million but has no idea about markets and they just want to retire. That's your responsibility. It's not about getting likes, clicks, shares, all that crap. It is about, can you make decisions for people who work their butts off in actual industries for their livelihood and their lifetime? Can you manage their money? And so that's a call out to the CMT Association as well. Are we going to be buy side or sell side? Are we going to sell research, or are we going to actually make impactful decisions for people who work in meaningful, tangible vocations to support everyday Americans and then have their retirement? Are we going to make decisions for them? Let's get beyond the fake. Let's get into the real.
Yeah, that's probably, I mean, there's a lot, like the CMT, for better or worse. I mean, it is a lot of research, people.
Like 80%. The CMT symposium, I'm calling you out. 80% of your education is outside.
Well, and that's what a lot of social media is, right? Those are the people posting stuff. I mean, I post stuff, but like they're posting, like it is their business to market themselves and get the chart out the quickest so that it gets retweeted the most. Like, and I get it. I'm not hating on that. But I think that's what a lot of people see of, I like technical analysis, and I mean, it's just a lot of people posting charts with the end goal of selling subscriptions to, like you said, you go to a CMT symposium. Hey, do you want to fly to Dubai? And 18 of our 27 speakers have never managed a dime of money. I'm going to be completely honest. Like, I don't. That doesn't intrigue me. Is that a snooty thing to say? Maybe.
I don't think that's snooty.
Really,
I think that's reality. I think it is. Why does technical analysis exist? Just to sell research? Or are we in the business of studying supply and demand because we want to do what's in the best interest of our client? Like, it is mind-boggling to me that you're more interested in selling subscriptions than it is in, I've got people that are relying on me daily to manage their funds that they work their asses off. Like, that is one of the biggest privileges in life, is to manage someone else's money who doesn't have a clue about markets. And they're entrusting you to do that. And technical analysis is the method that you use to manage risk and reward. But people are more interested in subscriptions and likes and shares and content. Give me a break. We need to up our game when it comes to our society, the charter market technicians, group. Like, how are we spending 80% of our time on sell side? I'm sorry. Like, let's get into buy side, like real applicable, real world. This is how we're using it to manage risk and reward for our clients. And I know I am coming across a little bit emotional, but it's getting a little bit old that our focus is on research. Like, this is real money, real people's money. And people, it could be $100,000, it could be $100 million. All of it matters. And if we're going to sit there and say, I'd rather have likes, shares, and content versus I'm taking care of Susie, who worked at XYZ company, who saved up her whole life, and now we're supposed to take care of that. That's complete.
Yeah, especially if you're young. If you're like 48 and your career is sell side, I'm not going to be like, oh yeah, go quit your job tomorrow and go be an analyst at a hedge fund. But if you've got the choice, if you are 22 with the world in front of you, yeah, just don't do this.
Do the noble thing. Do the noble thing, which means it's not about you. It's about other people. And there's a lot of other people that make this world go round than you. Like, I get super jazzed about what our clients do that make the world go round that I'm not capable of. But you know what I'm capable of? Because of technical analysis, managing their money. And so, to me, if you're listening to this and you're an up-and-comer, do not fall into the fame content thing. How can I serve other people? That is the question. How can I serve other people? And if you've been exposed to technical analysis because of Ian, because of this podcast, because of others, that's awesome. Use that to serve other people, not yourself. That's my end diatribe soapbox thing. And I think you've communicated it well, Ian.
Yeah. Thank you if you listened for that long and did not turn off the podcast.
We kind of got out of the soapbox there.
I mean, get out of the range and maybe I won't be so. I mean, it's just that's my 2 cents on where you're at. Because I do talk to a lot of younger people. They ask, tell me what they're interested in. Oh, should I get this here? I'm so interested in TA and here's what I want to do. And like I said, not all of them, but more than there should be. I think that's a great way. I'll end with that. There's definitely way more young men out there that want to use their skill set for clicks instead of going into the real world. And the real world has responsibility. Like, you're going to lose people's money. If you're good enough, you'll make more than you lose. But, there's going to be... But, of course, sell side, you can avoid that. You can't avoid that. There's a comfort zone that maybe a lot of young people would rather...
Well, Ian, it's one of the reasons why I locked onto you early, is that you were willing to put your pride aside, use the tools and gifts that you had to benefit our clients. And that's why you've been with us for 7 years. And kudos to you for that.
7 years next week.
29th.
Yeah.
And I just thank you for all the work that you've done for our clients. It is one thing to post content. It is another thing to manage other people's money. And you've done a fantastic job managing other people's money. And that is, I don't know how to stress that enough. That is a different league. And I appreciate you, appreciate what you've done for our clients. I'm hoping that this is motivation to others listening to this, that If you are just in it for the clicks or the sharing, quite frankly, that's not enough. You got to serve other people. And that is where the full reward will happen. And so, Ian, I thank you for the last 7 years. Fantastic job. We got next week yet, but 7 years.
Yeah, we'll have to get
you've
more
done a
into
great
that
job.
next week.
And I know we've gone over time, and I got to highlight the support of this podcast. The Adaptive Select ETF, listed on the New York Stock Exchange under ticker ADPV, helps investors access two of the most prevalent factors in markets, momentum and relative strength. Through proprietary identification methods, the Adaptive Select ETF attempts to own the strongest 25 large cap stocks when the market is in an uptrend, and since not all market environments are the same, Adaptive Select seeks to prevent extended declines by moving to short-term treasury bills and cash during long-term market downtrends. Investors can find out more, including how to invest in ADPV, by visiting adpvetf.com or calling 1-833-880-5200. Investing involves risk, including possible loss of principal. ADPV's distributor, Quasar Distributors, LLC. Ian, thanks for being on here. Thanks to everybody listening. We'll do it again next week.
Have a great weekend, everyone.